cloudy, cold, and snowy Chicago. I'm John Kosar, Chief Market Strategist and Portfolio Manager at Asbury Research. Thanks for viewing our latest Following the Money bi-weekly podcast. Today is Sunday, February 22nd, 2026. In today's podcast, our focus is on the benchmark S&P 500, which has not been trending on a tactical basis since late October of last year. However, small cap stocks are outperforming large cap stocks. Value stocks are outperforming growth stocks. Dividend stocks are also outperforming growth stocks. Bond prices are outperforming stock prices. Investor sentiment is historically bullish, and investor assets are leaving the market-leading NASDAQ 100 or the NDX. This is a very specific macro rotation that is not random. And all of these diverse things happen together. It usually points to a late cycle transition environment with rising macro uncertainty and tightening liquidity. We're going to look at several charts and some of Asbury Research's own data-driven models pertaining to this in just a couple of minutes. But before we do, let me take a minute to tell you a little bit about us. Asbury Research is a registered investment RIA. We have been providing investment research to both individuals and professional money managers since 2005, which makes this our 21st year business. More recently, we have created 4 model portfolios using our own in-house models like the Correction Protection Model, or CPM, and the SEAF model as building blocks for the purpose of providing trading signals for managed accounts. These portfolios have all been through rigorous 8-year back tests and have been trading in real time for the past 18 months by both individual investors and by professional money managers. These model portfolios are designed to produce S&P 500-like performance, but with significantly lower drawdowns and lower volatility, or to produce relative outperformance versus a broad market, but with similar or slightly lower risk than that of the S&P 500. For those that are interested in research, we have 2 different levels of research service available. Our Asbury Premium, which is what we launched the business on in 2005. This is for more serious investors. It includes updates on all of our models. You can find more about this service by clicking the Research tab, which is right here at the top of the webpage at asburyresearch.com, and then you could request further information from us by using the Contact tab, which is right here. We also have our entry-level Substack newsletter. Go to that now and have that. Here's our Substack. This is asburyresearch.substack.com. It's $25 a month, and it does not include any of our trading models, but offers selected reports and models from our premium research product at least 3 times per week. There's also a free version of the Substack news, and you can subscribe right here from this page. If you like our videos, if you like our approach to markets, I would strongly suggest that you sign up for the free version. It's going to get you more free stuff from us, help you to become more familiar with us, and it's not going to cost you anything. Kind of a no-brainer. And again, you could do that right here at asburyresearch.com. Or I'm sorry, asburyresearch.substack.com. If you're an individual investor or a portfolio manager and are interested in accessing our 4 model portfolios for managed accounts, you can click on the Managed Accounts tab right here. Now, we're back to asburyresearch.com and select the portfolio. If you go in here, you can select the portfolios that you're interested in, portfolio or portfolios that you're interested in, and we will send you some information about those. Now, let's get to what you came here for, our latest charts, data, and updates on all of our models. Let's begin with the Correction Protection Model. It's for risk control. So now we're in the Research Center. This is the paywall. If you were a subscriber, premium service, that allows you to get into the Research Center. We're going to CPM right here, Correction Protection Model. And here's a CPM. You can see CPM is currently risk off as of February the 5th. And you can see these green and red arrows show the risk on and risk off signals going all the way back to October of 2024. What it's very good at is finding the tactical tops and bottoms. You could see this is from November of 2023. We picked a couple of nice tops off here. The latter part of 24 and early in 25. This was 18, 24, February of 25. April 24th is when we got back into the market um, after we had that 18.9% drawdown, I believe, um, from top to bottom right here. CPM's drawdown was 9.3%, so about half. See, it's been a little choppy here because the market's been going sideways, but we're currently at a risk off signal as of February. The CPM model is a completely data driven dynamic stocks bonds allocation model. It was designed to replace the outdated, static, and arbitrary stocks bonds allocation, typically 60/40. Typically, if you've ever used Advisor before, you've had some variation of this. It completely disregards market conditions. It usually comes with a consultation of some kind to determine your risk and your risk tolerance and when you hire and a number of things they ask you, and then you get set into a static portfolio that's got some stocks, some bonds. It might have a little gold, it might have a little bit of international, but that's never made a whole lot of sense to us here because the market should be determining, or the market conditions should be determining how you're exposed and not conversation that you had with somebody 3 years ago. Here's a good time to show you. So AOR, which is the blue line here, um, AOR is an ETF that emulates a 60/40 stocks and bonds portfolio. This is going all the way back to the inception of CPM, which was 4 of 2017. CPM is the green line. So you can see people go to a 60/40 bond portfolio because they believe it gives them some downside protection. When the stock market is weak, the bond market will be strong and it will protect them on the downside. That doesn't always happen anymore. But the point is, we are showing two different assets or strategies, let's call them, both of them with some downside protection. And you can see how much better performance we're getting out of the CP. Again, tracks the S&P 500, but it is downside protection. Our back testing shows us that CPM, back over to CPM. Our back testing um, shows that CPM has stayed right with the S&P 500 over the past 8 years, but with 40% less risk. CPM utilizes 6 quantitative inputs to determine the daily internal health of the stock market. It objectively and quantitatively determines if investors should be adding or subtracting assets from their stock portfolios. Stock market, it's really a simple tool. There's not a lot of moving parts here. We're not using options or futures or hedging. When the stock market is internally healthy, according to CPM, the model is fully invested in the S&P. For that, we use the ETF SPY. When the stock market is internally weak and vulnerable, according to CPM, the model is fully invested in short-term treasuries. Right now, we're using the ETF BIL. So what we've got is a dynamic stock and bond portfolio that is controlled by market conditions rather than that set it and forget it approach. Again, CPM currently risk off as of February the 5th. Take a look at that chart just so you can have maybe a better understanding of how it works. So this is year to date, very short chunk of data here, but CPM is in green and SPX is in blue. The S&P 500 is in blue. So we were risk on here since the beginning of the year, which is why you see these two lines almost right on top of each other. Since February the 4th, that's when CPM went to risk off. So that is why the CPM line, the green line, is static. It's retained the it's it's basically retained how well it's done all the way up to February 4th, where you see we've got some weakness and some downside oscillation here in the S&P 500. So basically, that's all we're doing here is we're moving in and out of the market so we can protect ourselves on the downside when the market appears to be according to CPM. And then at some point, if the market strengthens according to the six constituent metrics that are inside this, the CPM, it will go back to the next thing we're going to do, we're going to bounce back here to the website, and we're going to move to our sector rotation model. And you can see once you get inside the research center, all of these models are right up top. Access. So now we're in SEAF. Here's our SEAF page, and the SEAF model is. Let's scroll down to the SEAF graphic here so we can get. The SEAF model is a completely data-driven sector rotation model created to quantitatively identify long and overweight opportunities in U.S. market sectors by simply following the money around the 11 sector spiders, which together comprise the S&P 500 in multiple time frames. So basically, we've built an algorithm that measures the velocity of money as it moves around those 11 sector spiders, which are right here, which if you put them together, it's the S&P 500 broken up into 11 pieces. Then we measure the speed of money moving in or out in three different time frames. We have trading and tactical and strategic, and the fastest money in is going to get the lowest score. So over the past trading week, the fastest money in, it came from industrials, which is number one, and energy, which is number two. Fastest money leaving any particular sector over the past week, the fastest money out was coming from financials here in the trading time frame. So that's how this works. And then we add up the three individual scores for the three time frames. It gives us a ranking number. So the top three in terms of ranking this week are energy, industrials, and the material sector. So it's XLE, XLI, XLB. Now, SEAF model is always fully invested in the market. Doesn't matter if we're uptrend, downtrend, sideways trend. It basically was built to provide investors with a dynamic alternative to the traditional buy and hold part of a portfolio. If you're managing money, um, typically can't go to cash. You may be able to go move to cash maybe for 20% of the portfolio, but not for all of it. And most individual investors that I've come across, they don't like to be all in cash either. I don't personally. I like to have a little piece of my portfolio always in the market in case the market turns and starts to move higher. I've already got a toe in the pool, so to speak. So that's the purpose of SEAF, is to always keep a piece in the market, but you're always invested the places that the money is going to the fastest, and you're avoiding that the places where the money is coming from, to go to those better places. According to our back tests, the SEAF model has significantly outperformed the S&P 500 on an annualized basis over the past 8 years, but with a lower maximum drawdown. Currently, again, SEAF is overweight energy, industrials, materials. Year to date, SEAF is outperforming SPY by 9.8% just on the strength of these allocations. It's early in the year. I don't, I'm not going to go out and have a party because SEAF is having a good first quarter, but it's doing what it's supposed to do. It's been in energy and industrials pretty much since the beginning of the year. That's where the money's been going. That's where the performance has been. That's allowed us to outperform. The next thing we're going to do is we're going to move to one of the reports that are part of the premium service, and there's actually a very similar product that's a part of the Substack. So you get that once a week. But there's some key charts in here to look at. So keys to this week. October tactical decision continues amid strategic red flags. So first chart, I'm going to pull out a few of these. First chart is the S&P 500. October the 29th was when we made that initial peak. It was at 69.20. We had an upside target of 69.50 dating back to last summer, end of June, I believe it was. So once we hit October 29th and we started to back off, that was kind of what we expected here because I'm not the only person on earth that can read charts. Other people were looking at that 69.50 area. Undoubtedly, we had a pullback from there, but we really haven't been able to do much since. We got up to 7,000. It's a big fat number, and when you're at all-time highs, it becomes a resistance level. But you can see we're kind of stuck in a range here. The area that I'm keeping the closest tabs on is the one that's been holding since the latter part of January. It's the low that we made at 67.89 on Jan the 20th. Tested it again on February 5th and February 17th. If we break down through there, to me, that would be a place that we may look for a trend reversal. The S&P is up, 45% from bottom to top since April of last year. So it's overstretched historically, which makes it vulnerable to a correction. The next chart here looks at SCHD, which is it's the Schwab U.S. Dividend Equity ETF. The point here, so we've got SCHD versus growth here. So this is basically a dividend ETF versus a growth ETF, SPY G for that. And since December the 11th, dividends stocks are outperforming growth stocks. That typically does not happen in a healthy bull market. That usually happens in a market where there's some apprehension as to how much further the uptrend can go, or there's some economic issues that are collectively troubling investors. But this, I wanted to point this out today because this is not something that you see in a rip roaring healthy bull market, but rather in a tentative bull market that's losing confidence. Scroll down and look at another one. This is SPY versus AG. Actually, this is the one I want. This is the total net assets invested in the Qs. The Qs track the NASDAQ 100, the NDX, and they're typically the leader in a healthy bull market. You can see on May the 12th, those assets expanded above their 63-day moving average business quarter, which fuel this nice move higher that we've had in stocks. You can see that those assets came down to test the 63-day moving average on November 20th, December 17th, and Jan 20. Those are all little minor bottoms. You had some buying coming in. It shows up on the lower panel here, but the market couldn't do anything with them. They all kind of got up to the old highs and faded. Now, as of February the 4th, these assets are now starting to contract on a 63-day basis. It's certainly big warning for those that are invested in large cap tech. But because tech tends to lead the overall broad market, and the linear correlation between NDX and the S&P 500 has been tight and stable throughout the series for 30 years. So this is a warning sign to me. I wanted to show it to you, make sure you're aware of it. This is another one. This is investor sentiment. This is the investors intelligence data. Excuse me. Asbury Research is actually one of the inputs for this data series. We obviously data from them, and what it's showing right now is the number of bears, percentage of bears, and these are newsletter writers. What I was looking for. These are people like us who write some kind of an advisory letter or have an online service like we do. The point is, they are at a least bearish extreme right now. Previous instances of that have picked off or gotten close to really would have been the most important peaks in the S&P 500 going all the way back to 2011. So this is about a 15-year chart here. So this is not a sell signal by itself, but this does tell us that the market's offsides in its thinking, or at least these newsletter writers, uh, these advisory services are offside, and they're a little too bullish. They're a little too happy, and oftentimes that is the starting point of some kind of a correction. So again, not actionable. It's not meant to be a sell signal that you use tactically, but it is something I think you should be aware of. And then the last one here, this is seasonality. I look at seasonality as kind of a tertiary indicator, um, but when it fits in with the rest of the scenario, I pay more attention to it. That is the case now. What this is showing is between February 23rd and March 9th, this 3 week period. I should back up. This is weekly seasonality pattern in the S&P 500 for the first quarter. So there's 13 bars here to represent the 13 weeks that are in the first quarter. The data starts in 1957 and it goes through the end of last year. What it's showing is the next 3 weeks from February 23rd to March 9th are the weakest 3 weeks in the quarter. So just something to be aware of as we're heading into next week. The next thing we're going to do, this is another part of our premium service. These are ETF trade ideas. Um, Basically, what we've done is we've built a screen that we use to screen 6,600 ETFs every morning, hours before the opening in New York. And we scan them with particular criteria that um, we've created. To point out positive price trends according to our own methodology, um, relative outperformance versus the S&P 500, and expanding investor assets. And then every day it gives us a list of ETFs. Sometimes there's 5, sometimes there's 25. Depends on the market. But then we look at these and then we put one further piece of criteria in. We make sure that their risk reward profile is attractive. Um, Small risk for possibly large gain. And this is this repeatable process that we've created so we can find opportunities across a lot of ETFs and we can screen them quickly and quantitatively and then go on and find the ones that we like best. Here's our current open ideas. Let's make this bigger. So you see, we have 4 of these right now. The one we're going to look at is the oldest one on this list, and that's XES. You can see that we initiated the idea on January the 14th. Um, the initial target on this is 99.22. Valid above is basically our soft spot, or stop rather. We don't use hard stops anymore. We think in this environment with all this volatility, it's really hard to do that. So we use what's called a soft stop at 104.22. You can see so far this has risen by 21%, outperforming the S&P by 22%. We can take a look at that here. So here's XES. We initially got into the idea right here on the white arrows. So this is the outright daily chart of XES. Down here is the daily relative performance chart of XES versus SPY. We look at everything through the lens of how is it doing versus SPY. As to us, SPY is the market, and if our idea isn't beating the S&P 500, then you really don't need it. Our criteria here is we want to put out ideas that are going to beat the market. I don't understand people that have something in their portfolio that's making money, but the S&P 500 is beating it by 6 or 7% for the year. What's the point? Why not wait until that particular asset starts to perform better instead of, again, that set it, forget it approach that doesn't take into consideration what's going on in the market right now. So you can see here where we put the idea on, and it gains some acceleration here because we broke this big resistance level that went all the way back to September of 2023 couple of weeks ago, and now this has some room to move. So again, when we put this on, it wasn't really starting the world on fire, but our process allows us to get on top of these trades a little bit sooner, maybe than others do, and then we're able to catch the retro rockets. And start to, let's go back here, and just last year to point out we got into gold miners, RING, on August the 6th of last year. We got out on October the 21st. We made 31% outright, and we outperformed the S&P by 31%. Then we moved out. A lot of people said, John, why'd you get out of the market? It was making so much money because our criteria started to shift and we didn't want to give away all those profits. So what we did is we got back into Ring again on November 26th, right around Thanksgiving. And then we exited that idea on January the 30th, and we made an additional 21% outright, and we outperformed the S&P by 25%. Reason that I'm telling you this is these trades are tactical. These aren't a long-term investment, but these are tactical ideas. Um, see what I'm talking about on this table. We almost have 3 years of data here following this exact repeatable strategy. We have 120 trades from March of 2023. Now this is actually through January the 9th. So this isn't going to XCS trade a few more. But during this period, we've had 120 trades. Um, our average, our 54% of the trades made money. 54% of the trades are winners. Average winning trade here was 5.5%. And we're in those trades, we're in the winning trades on average 20 trading days, which is 1 day shy of business month. Our average losing trade was less than half of that, only 2.4%. Average losing trade length was 8 days, or about a week and a half on the calendar. Our Sharp ratio is extraordinarily high, 1.4%, and our maximum drawdown was only 3.7%. So these are very low risk trades with very, very good risk adjusted returns according to the Sharp ratio. So again, this is not picking out ideas because of what I've heard on TV or because there was a certain chart pattern, that I could identify on the chart, but looking at a lot of different criteria and scanning thousands and thousands of ETFs to try to find those special ones that are going to give us exceptional risk reward potential. The Asbury 6, which we didn't look at today, the CPM, the SEAF model, and our ETF trade ideas are all a part of Asbury Research's premium research service. Contact us here by the contact tab at asburyresearch.com to request information about the service details, pricing. Now let's just take a quick look at our Substack entry level product. That is right here. So we've got 2 reports that are in the service right now, and we're adding a third. Our first one is our chart focus, which you can see very similar to Keys to This Week. A lot of dialogue, a lot of charts. Our second one is our sort report, and our sort report is here. We're going to talk about this a little bit more depth in just a second. And then our third one that we're adding is our SEAF rainbow charts. And take a look at one of those here. So this is the rainbow chart, a bit bigger. So this is a rainbow chart. For obvious reasons, we call them rainbow charts. And what that is a daily line chart showing you on each of the 11 sector spiders that we track with the SEAF model. This one happens to be energy, and it shows you throughout the past year how the scoring, the SEAF scoring, it goes from favored up here, which is green, and yellow, which is neutral, and down to red, which is void. see that came out of a void um, back here, um, latter part of December, and then we moved through the neutral area pretty quickly. And since January the 13th, it's been favored. That's why it shows up as either number one or number two on our SEAF model week after week after week. It's been about 6 or 7 weeks already. So this allowed us to get on that trend early and to identify an opportunity here in energy when frankly I don't think a lot of people were talking about it. So we're following the money. We're not following the banter. We're not looking so much at a broken trend line or a stochastic. You can kind of get those anywhere, but this is our own methodology that we built. Follow the money as it moves around the 11 sector spiders because it shows real conviction, real skin in the game, collectively from investors that they like this particular sector. Again, we're going to add this within the next week or so. You're not going to get all of the 11 charts, but you're going to get 3 of them every week. So you'll be able to kind of follow along with SEAF model a little bit closer by seeing these charts and seeing the historic background of these charts going back a year. Let's talk about sort. And here is the sort report. Um, a word that we've been hearing in the financial television over the past week or two is dispersion. Everyone talks about dispersion. It's like, the word du jour. But what it means is what this is showing in the sort report, and this is updated, I think, twice a week within Substack. It looks at all these um, different assets. We have emerging markets. We have global equities minus the US, crude oil, interest rates, commodities, small cap, US dollar, gold, technology, and we even follow crypto. So what this is showing all of these that are clicking on all 3 cylinders, so to speak, positive trends, positive relative performance, and positive money flows according to our own criteria. These are the ones that are doing the best, and they're spread all over the place. We have commodities, we have rates, we have crude oil, uh, we have emerging markets. This kind of dispersion is pretty unusual, but what this helps us to do, this sort report helps us to do, is to be able to put a lot of different diverse asset classes kind of into a sifter, show us those specific assets that are trending properly. They're outperforming their peers, and they have assets going into them to help to propel them higher. So again, these are 3 parts of the Substack that we do. It's nowhere near as in depth as Asbury Premium. It doesn't include our models, but it does give you a lot of information, tell you where opportunity exists in the financial markets. So that's going to wrap it up for today. Get back over here to asburyresearch.com. Our next Follow the Money podcast is tentatively scheduled 2 weeks from now. It'll be Sunday, March the 8th. Hope to see you then. Meantime, if you have any questions about anything that we talked about today or want more information on our research subscriptions or our managed account services, you can contact us right here by the contact tab, asburyresearch.com. See you in 2 weeks. Stay warm, enjoy the Olympics, and make sure that you like and subscribe.